The Ron's dominating today. Got to create some kind of Ron alliance. Hi, Denise. How are you doing in New Hampshire? It's probably beautiful there right now as things have warmed up. All right, Mike, you can hear me now. Good, good, good. Yeah, but we're in a pretty positive atmosphere right now. It almost makes me nervous that it's too positive. I talked about I thought that this kind of end of April and beginning of May would be really positive, and it's a little outdoing my expectations, which always then starts to make me nervous. If you guys have followed me for the last couple of months, I've kind of been, I guess, what you would say, a little contrarian since like the 490 area of the SPY, and said I think this thing's going back to the liberation gap of 564. And we've amazingly got within about 1% of that already. And it's May 1st. And we're already within 1% of that Liberation Day gap, which, like I said, is great. Most of my strategies are net bullish, so obviously love that. But it's almost happening so fast and kind of having some of those days like yesterday where you have bad news and flushes and you still have enough optimism to push the market back up that I kind of say, oh, we might need retail might be getting a little too frenzy here. We might need to have another flush. But we've had 8 in a row on overnight options, eight wins in a row, which is nice because obviously when the market's tearing to the downside, we've had one of the ugliest flushes in 10 years. We took some hits on overnight options, so great to have a little winning streak there. Did anyone get filled on automated options on the QQQ from last Friday? I didn't get filled yet, but I also always wait and put my trade in later just to make sure I'm not front running anyone. But curious if anyone got hit their target there. It should be within a couple pennies right now, so it'd be great to get another one of those winners. And then, of course, I think the story for today, what we'll talk about on the training, is our meta trade from yesterday. Any of my jump traders in here who, wow, we got another Ron. This is unbelievable. Any any of my jump traders who hit the meta trade this morning for over 100% in about what 40 minutes of market. Well, I guess I sent it a little earlier. 2 hours of market action. Yeah, that was a nice one. We've got Christine who hit it and Kathy. Hi, Linda. Linda got it as well. Oh, Hank, you went for a little more. You went for 240. So you're like at 120%. Hank got some action. Um, so that is one of the things we want to talk about. Gerard got it. Okay. Let me pull up my slides here so we can get rolling. There you go. You should see that terrifying big bobblehead of my face now if you're looking at my screen. You might have on Zoom, you might have to set up your screen view just to make sure you're seeing my screen share and not just the live video. But we're going to talk about quite a few things today. First, I want to remind you of this watch list of highly rated stocks. I posted this yesterday. I'll post it one more time for you today. There's a little bit of a backstory behind these stocks that I am not able to share completely yet, but I just want you guys to keep an eye on them. If you trade any of them, let me know. What's interesting about this list of stocks that I just posted there in the chat is what you'll probably notice if you scan through them. They don't have a lot in common. There's not a technical consistency or anything like that that they're going to have in common. They have a very different set of criteria that make them highly rated, highly desirable stocks based on some criteria. That doesn't mean they've all triggered in terms of quote unquote a trade, but they should make the watch list. And I'll share more about this in the coming weeks, kind of where this list is derived from, because I think it's actually very cool. But for now, I just wanted to kind of give you a sneak peek. I think these are good ones to keep your eye on. A couple of them already actually have triggered in the last week or so and been really nice trades. And so I'll keep you updated. But for those of you who want to check out these stocks, I just posted it right there directly in the chat for you. Diane, the target for the Q's trade, which is the automated option trade, is right around 50%. I mean, that's typically what we're targeting, right around a 50% ROI within the next 14 days, and just kind of stack those 50% winners. And so that one's very close. Like I said, it hasn't hit my target, it hasn't filled, but it's like a couple pennies away. And I always wait and put my trades in after I send the alert. And so I figured some of the members already got hit with the target maybe this morning at the open, or if not, should be very, very close. Speaking of income trades, wanted to give you today's income machine play. This is a tool that I've also been working on. I've got a lot of, you guys know me, I've got a lot of stuff in the works as always. But the income machine is going to be super, super cool. Probably one of the coolest things I've ever built, maybe the coolest thing I've ever built. Because what it's going to do is it's going to give you a recommended income place. And then as you click through it, this is just a screenshot, but as you click through it, it's going to give you the parameters of why it's a good income trade. It's going to let you choose whether you want a moderate, aggressive, or safe income trade. And then it's going to spit out the exact options criteria for you all inside the little app that I'm building. So it's super cool. But for right now, I just want to give you a couple free ideas from it before I get it totally finalized here in the next couple of weeks. And so today's is on XLI. Now, I pulled this trade right at the market open. And I'm guessing, if someone doesn't mind looking this up for me right now, I'm guessing this price has moved up, because I think XLI is now up almost 1%, where it was closer to like 0.2% when I pulled it. But the trade here, if someone has their broker platform handy and could look it up, well, I guess I could do it right now, actually. Why don't I just, while we're doing it, let's see. XLI. This is a one-day trade, by the way. This is just literally for tomorrow. We have the 130, 131. Let me look at it here. Yeah, that price has moved up about 10 cents. All right, let me update this for you, and let's do the 131, 132. A little more aggressive because we only have about 40 cents of room. In other words, it's only about 40 cents above what we would call the line in the sand, for those of you who are familiar with how I trade. But let's see. Yeah, okay, so that should be about 70 cents. So unfortunately, if we would have done this session right at market open, we would have got a whole dollar better on this XLI trade from the income machine. That's the one that I took, but you can still get in here. I'll go ahead and take this one too. Let's see if I can get in for 68, 69 cents. Give me a second. I just want to I like to take the trades, even if it's just a contract or two, just so that I can track them with you guys. We'll see if that gets filled. But the idea here, let me update this, is if XLI expires above the top level, then it's going to be a 42.8% ROI in one day. And so what the income machine is all about doing is trying to find these situations where you get an advantageous income relative to what the stock needs to do. And so it's always looking for opportunities where, based on the factors that we've kind of baked into it, it says, listen, the odds are high that this stock is not going to come back this amount, or it's going to go up this amount, or you have enough room here, and the income opportunity is net positive relative to those scenarios. So what it's saying right now, what the income machine is telling you right now is, listen, the odds are pretty good that XLI is not going to drop, 60 cents, net 60 cents in the next day. Just, it obviously could. Certainly, income machine will have losing trades, but it's basically just running those numbers and saying, for the income opportunity that you get, 42% is a really good, kind of ROI percentage on the probability of XLI coming against you. So that's the whole concept of the trade. Like I said, would have been great if we got it in the dollar lower, because then your odds of winning the trade, shoot up another high percentage. But just failed, by the way, 70 cents. I don't know if you guys heard the ding. Okay, so all we're doing, really simple here on this trade, is nothing. All we're doing is nothing. We're going to let it expire above 132 tomorrow. If you had my original trade, it would be above 131, but the official trade above 132 tomorrow. And if not, it'll expire below 131. It'll be a loser. If it's in between, I'll shoot you guys an update and say, hey, let's XLI's in between. Let's take a partial win or a partial loss. But outside of that, either above or below. Now, as you guys know, if you follow me at all, I would usually put a target on these trades, just like I do in overnight options, automated options, jump trades. Almost all the time when I trade these kind of trades, I use a target. One of the things that makes Income Machine a little bit different and that I'm testing out is it's really defining the odds based on if you let it expire. So it's really doing the math based on letting the trade expire for either a full win or a full loss. And so I'm going to practice doing that because that's very atypical for me. I would usually use a target, but I'm going to take a little page out of Graham's book here, and because that's what the Income Machine's odds are based on, um, and see if we can get some more full targets because obviously, 42% is better than 20%, right? If you can hit it consistently. So anyway, just a little sidebar there of something that you'll see me do a little bit more on the Income Machine that I wouldn't typically do in other strategies. All right, so let me go ahead. I'll post this trade one more time for you guys in the chat there. This is XLI, not a ticker that I usually trade, but it popped up on the Income Machine, so we're going to take it. All right. Of course, earnings to watch. Microsoft and Meta, nice beats on both. Graham and I told you guys last Friday and again on Monday that we were both fairly optimistic on earnings this cycle just because of the nature of where stocks are. So far, so good. Doesn't mean everything's going to be a beat, but so far, so good. A lot of the big names have won. Eli Lilly, by the way, took a hit. So not a winner on Eli Lilly today. At least last I checked, it was down quite a bit. I haven't looked at it since about 9:45, but last I hit, Eli Lilly did take a hit. But I'm still pretty optimistic net. Now, what does optimistic actually mean in terms of earnings? Well, it probably means 55% go up and 45% go down. We're not talking about, hey, I'm optimistic, so 90% of earnings calls are going to result in big winners. Obviously, that's certainly not what I'm saying. But I'm net optimistic, and what I'm mostly optimistic on is the big names with the big followings that are beat down, that they just don't need to do a whole lot to get some positivity. I just don't think that Microsoft, Meta, Apple, Tesla, the companies that have big fans need to do a whole lot to get some optimism. And of course, Tesla is a good example because their earnings were terrible. They didn't even do a lot of positive future guidance. The deliveries right before that were a big, ugly miss, and they still got a nice little pop on earnings. Not huge, but a little pop. And I think that's more the sentiment that we're in right now for these juggernaut companies. Some of those I'm going to be totally wrong on. Like Apple, I'm going to trade today. Do you guys want to do the Apple trade live at the end of the session? I'll show you exactly how I'm going to do it, just like we did the meta trade yesterday. If you guys want to take it live, normally I'd wait toward the end of the day, but I'm happy to do it live with all of you here on Opening Playbook. And so Apple's a great example. It's one that I have optimism on, but it's still earnings, guys. I mean, it's still earnings. It could easily bomb. Like I'm not taking this as a normal high confidence trade. I'm taking it as a high confidence trade in the context of earnings. So I want to be obviously super clear on that. But I like Amazon and Apple. Reddit is a fun little one just because of the fact that they did this new pricing model. And so their earnings could be, I think, dramatic on either side. Might be one that you consider taking a two-way trade on because of their situation. And then we've got some energy tomorrow before the open that I think should be interesting as well. Reminders before we get into today's training, all my members, you can email me directly. It's in your members area. If you have questions, feel free to send me a personal email. I will respond personally. It doesn't always mean I'll get back within 10 minutes. I have a pretty busy schedule, but I will try to respond within as timely of a manner as I can just to make sure that, you guys get a direct answer from me and you're not waiting around for someone who maybe doesn't understand how the strategies work, intimately and all that kind of stuff. Obviously, make sure you're in my Telegram. Make sure you're in my text list. If you're not in my text list, I send a stock of the day each day via text. So make sure that you're signed up for that. If you're not on that list, Joseph, let me find a link real quick here for you. Here you go, Joseph. If you are not on this list, Sorry, can't copy and paste. There you go. In the chat there, just add your number, click the box, and you will get the daily text. All right, so today's training is all about showing you the best way that I know of to go for big gains while still trading inside the expected move. You guys will hear me use that term expected move a lot. We'll dive a little bit deeper into it today. But to really, the expected move, I personally believe is probably the number one reason that traders end up failing with options. And so you'll often hear me call this a jump trade because it's a directional trade where we need the price to make a jump. So it's an active directional trade. Tracy and Peter, if you click that link that I posted in the chat, enter your number in that box, and you will get the trade of the day. Okay, so let me give you the meta earnings example that we took yesterday. Let me pull up my pen because you guys know I can't talk without drawing on a screen. I have a compulsion to to draw on the screen when I am trying to explain things. So, bear with me. Let me pull up my pen. Here it is. So this was the trade that we took yesterday. Give me one more shout out in the chat if you hit the trade. I know a couple of you already mentioned it, but I just want to give everyone a proper shout out because it's no small feat making over 100% gain on a trade. You guys deserve a round of applause. So just one more time, give me a yes in the chat there if you traded Meta yesterday. All right. Linda, RJ, Maggie, iPad 6, whoever you are, thank you. Dan, Jim. Sorry, I missed a few. I got a couple other chats and I missed a few there. But, let me scroll back up. Okay. What we did, Christine, Jim, yes. Okay. Nick, beautiful. Okay. So all of you guys who made over 100% in about an hour of market time, here's what we did. Meta had earnings. The expected move is this yellow box. Okay. So this is the yellow box of the expected move. I don't know if I have, it's a good, I always mean to do that, update the chat, but I don't think I'm even the proper host. Might need Deanna to do it. Yeah, it doesn't look like I actually have the ability to update the chat settings because I'm not the official host. But Deanna could probably do it where you can open up and see everyone's chats. I always mean to do that on Opening Playbook in my classes and forget every time. So this is the expected move here on Meta. Basically, before earnings, they were saying there's like a $30+ move. And that, of course, means that it could be on either side, right? So on either side, yes, this is the market maker move. So on either side, they're saying, listen, Tesla could go up $30, down $30. Not only could it go up, but that's actually the expectation is that it will move, about $30 on either side. The problem with how most people trade is then they buy a call and they need to outperform that expected move to make any money. Now, in this case, Meta actually has outperformed so far to the upside. Okay, so that's rare. I shouldn't say rare. It's about 30% of the time, but it doesn't happen a lot. And so Meta, in this case, outperform is starting to come back a little bit here. But the problem with the call options is that you need to outperform consistently. And 70 to 80% of the time, you're going to either not outperform or you just get the direction outright wrong. What we did was this little green box. Does everyone see this little green box here? This little green box is our jump trade. Instead of saying that we need the market to outperform $30, we just needed Meta to finish above here. So anywhere inside this expected move, as long as it was going up, we were going to end up with a winning trade. And then what we did is we put a target on it just in case we got a big pop like we did to get filled early. Okay, so this is really at the core level what a jump trade is. It's saying, listen, the market expects a move, of $20 or $30 or whatever. In this case, we're going for a much smaller move, but we're going to restructure the trade to put us in position to make a higher percentage, whereas, regular options wouldn't really return anything significant. So today, this training is all about how do we do that. Okay. If you guys, if you don't see the screen, you should be seeing my screen. You need to maybe hit like the view options or something on there. GG, I think everyone else is seeing my screen, but you might have to go into your settings there and like, I forget what the term is, but click something like screen view or again, maybe someone smarter than me, Dion, or someone can tell you what the term is, but there's something in there uh, that will reframe the screen so that you can see not just me, but the whole screen. Okay, so what are jump trades? Jump trades are a way to twist options that go for big gains on relatively small moves in the stock. Just like Meta, we only got a small move, but we ended up at over 100% ROI. Regular calls and puts have to overcome an expected move, but jump trades do not. And one of my favorite examples of this is actually a different trade on Meta from last year. So not the trade we took yesterday, which great example, but this is one of my favorite examples, which goes back to March of last year. So this was March, again, over a year ago, but I just love this example because the data is so crazy to me, where I took this trade on the 19th. By the way, I actually shared this one on Telegram. Anyone, if you guys remember a year plus ago, you might have taken this trade. So Meta moved up exactly like I hoped to about 508. So my target was anything above 505. It moved to 508. All right. Now, on that 3% move on Meta, the jump trade made 194%. Okay, so that was the gain that I walked away with on that Meta trade. The crazy thing is, if you look at this, which looks like a perfectly good trade, good timing, good move up, what happens if you bought the regular call? So I did this based on like the 30-day out calls. They were actually down roughly 16%. And that's why this example always blows me away, is that you have a perfectly timed trade that went up 3% and regular calls actually lost money. So a regular option that nailed both direction and timing, because that's always the hard part, to get direction and timing right. Well, this option did both of that, nailed the direction and timing, and yet actually lost money. And this is precisely what jump trades is attempting to flip on its head. So today, I want to walk you through how jump trades are able to do that. We're talking about the two big problems with regular options, how we structure jump trades differently, how the structure actually works, the win-loss scenarios, the step-by-step, at least one real-world example, and then a live trade on Apple, a summary of how it all works. We're going to cover quite a bit here, but I'm trying to run through it as quickly and efficiently as I can, and hopefully you have a light bulb moment here of how this all works. So let's start with the two big problems with regular options. Okay, so the first one, most people know, time decay, right? Most people have heard of time decay, and they know time decay is something you have to overcome with options. Time decay kills the value of regular options unless the stock is moving aggressively in your favor. Okay, so time decay is basically eating away what they call the intrinsic value of an option. Anytime it's not moving in your favor and it's just sitting there, you're losing time value because you're not moving up, you're losing net time value. And it's much, much worse if you're going for aggressive moves like we are in jump trades. Okay, so for example, if Apple is trading at 230 and you want to target a big gain on the options, you would typically trade what we call an out-of-the-money option, right? Most of you are probably familiar. That means you're going for an option for a price that Apple's not at yet. You might buy a 235 call option requiring Apple to move $5 a share, although the $5 is actually a trick, which I'll show you in a moment. The problem here is that if Apple sits around 230 or even moves up a few dollars, the option is actually draining money. Okay, so you could use you could see your trade go up a few dollars over the course of a few weeks and still be down 90% on the option, which is brutal. But it gets worse because the second problem with options. So problem number two is what we call the expected move, or what you guys might see as the market maker move. So you might think if Apple's trading at 230 and you bought a 235 call, that you need Apple to move $5 to make some serious money. I don't know about you, but that's what I thought when I first started trading options. I thought, listen, if Apple's trading at 230 and I buy a 235 call and it moves up to 235, bingo, bango, I'm going to be making some money. But unfortunately, that would be wrong. You see, not only do you have to get the direction right and overcome that $5 price move, you also have to overcome the expected move on top of that. So here's an example of an option chain, right? People think they're targeting this price, the strike. They think they're targeting where price needs to go. In reality, they have to overcome this price, guys, not to make money, just to break even, which is pretty crazy when you think about it. Now, I mean, let's just take a look here. So in the example right now, which Apple was right around, I think 231 or something like this. You buy this 235 call. You think, listen, if Apple goes up to 235, I'll be in great position to make some money. But look at the break even price. It's 240. That means if you use the whole time of the option and it goes up to 240, it goes $5 above your strike price, you're not making 100%, you're not making 200%, you are just at your break even price. Okay, so you're not trading against the strike price, you are trading against this expected move. Everyone, thumbs up. Yes, that makes sense, because this is where, most traders have never even looked at the break even price. They've traded 1,000 trades and they never even realized the price that they're trading against. You're trading against this expected move, not just the strike price where you have set as your target. Okay, which again is kind of shocking when you think about how crazy that is. And by the way, if I can just go on a quick diatribe here, this is not some accident. It's not like the stock market is broken. The options market isn't broken. This is what market makers do because they want to make money. And they do make money because of this. I won't go too far down the soapbox there, but just as a side note. Okay. So this is really the reason why so many people lose with options. They're not always picking bad trades. The options themselves are literally rigged against you, just like this example. I mean, I'm not using the term rigged lightly. I'm using it pretty sincerely here. They are literally rigged against people trying to make money. So listen, I hear all these people get on, these quote unquote gurus who get online and they say things like, yeah, retail traders, just the dumb money. They're just always picking bad trades. And that's not completely wrong. I mean, obviously, I believe that, retail traders have a challenge picking good trades versus bad trades. So I'm not saying that's completely wrong, but I do think it's a massive oversimplification. It's not like retail traders are just always picking the wrong stocks. It's not like retail traders in 2024 had no idea that NVIDIA was going up. Okay. It's that the trade structure itself causes them to lose more than they should. And I think that's really important. If you've been told, hey, you just always pick the wrong trade, you're just always wrong on direction. If you go back and look at your trades, you're probably not. That's probably not true. Maybe you're not the best stock picker in the world because stock picking and timing is really hard, but it probably has a ton to do with the options themselves and not just that you're picking lots of bad trades. And that's really why I invented jump trades. So let's talk about what the jump trade structure is, because it basically is designed to counteract the two issues we just talked about. First, we counteract time decay by using a debit spread. You guys know I love debit spreads. And a debit spread sells an option at the same time as buying an option. This means that if the call option we bought is losing value because it's not moving up quickly, the call option we sold is gaining value to counteract it. That's why debit spreads don't lose value the same way that regular call options lose value. Second, we counteract the expected move by picking our own true price target. We're not picking 135 and not realizing it needs to go to 138 or 140, which, by the way, is a moving target. We are picking a true price target. So we don't have to overcome any extra volatility because the spread does that automatically for us. So let's go through an example so you can see how powerful this actually is. So again, let's assume that Apple's trading at 230 and we want to target 235, just like the call example I gave you. Well, the regular approach would be to buy the 235 call option, right? That's what most people do. But the jump trade approach would be to buy the 232.50 and to sell the 235 call option. Okay, so those, just so we're clear, I'll actually put this in the chat just so you can reference it here. If you're targeting 235, these are the two different approaches. One, most people would buy the 235 call. Here, we're buying the 232.50. We're selling the 235 call. And let's look at the scenarios that can happen on this trade. Hopefully, this gives you more of a light bulb moment here as we go through the scenario. So scenario one is that Apple goes down, aka we're wrong. Okay, so we just missed it. The direction was not correct. We missed it. Apple goes down. Well, of course, the call option is going to lose, and the jump trade is going to lose, right? So we're going to lose on both situations on a directional trade if we're wrong. All right, let's say Apple goes to 234. So it doesn't get quite to 235, but it gets close. It gets up to 234. Well, the call option is going to lose 100% of its value. Negative, if you put $1,000, you're down $1,000. The jump trade is actually going to gain about 50%. Now, I shouldn't say exactly 50% because it could depend on a few other factors, but around 50%. Could be 30, could be 40, could be 60. It's going to gain around 50% in that scenario, depending on a few factors, most importantly, what you paid for the trade. Well, let's say Apple goes to 236. Now, this is the crazy one, folks. This is the example that hopefully will blow your mind. Because if Apple goes to 236 and you bought the 235 and it uses all of your time to get there, that call option still loses 100% of its value, which is pretty crazy. But the jump trade here would gain 200%. So the ROI is between negative 100% and positive 200%. Now, if Apple goes to 238, now your call option hit that break-even number, okay? Because in the example that I pulled earlier, 238 was the break-even. This is from, I don't know, months ago, but its example holds true today. You just look at different numbers. So in this case, 238 was the break-even number. The call option would now make you break-even. So great job. Apple moved up $8 and you got a break-even trade, which is ridiculous. The jump trade returned 200%. What if Apple goes up a lot? So let's say it goes up to 240 plus. Well, this is where the call option is good, right? Because the call option now has overcome the break. It's overcome the break even. It could make 1,000,000%. There's no cap to the call option. If Apple goes on a historic run, then you make a really great return. The jump trade is capped at this 200% gain. So in those 5 scenarios, the call option has 3 losers, basically full losers, 1 really nice win if you get a historic move, 1 break even. The jump trade has 3 huge wins, 1 smaller win, and 1 loss. Okay, and so that's the example of how these scenarios break down and why I think jump trades, if you're going for big moves or big trades, jump trades has such a massive advantage. Okay, now before we go on, I do want to be very, very, very clear on this next point, okay? Even though I believe that jump trades are exponentially more advantageous than call options, and I gave you kind of 4 out of 5 scenarios are good, we are still playing a directional move. So we still have to get that move in our favor. So 4 out of 5 scenarios, like I just showed you, doesn't mean we win 80% of the time on jump trades. Okay, just to be very clear here. Okay, but I do believe flipping these options on their head is the biggest advantage most regular traders can do inside a brokerage account. Plain and simple, if you learn to kind of flip these scenarios and not overcome the downside of regular call options, I believe it's the single biggest advantage regular traders can have. And like I said, I would even take that a step further and say it's the advantage that market makers don't want you to have. They want you to trade regular calls and puts because of the reasons that we just talked about. They're basically rigged against you. So let's talk about the step-by-step strategy here. Again, I'll try to be quick here so we can get into a live trade, but you guys can take these notes down. I'll even share this this slideshow with you so you can go through it at your own pace if you'd like. So first, I'm going to walk you through the steps, then we'll go through a real example. Okay, so step 1 is, of course, an entry trigger. Now, we don't have time to go into all the different ways that you could decide to enter the market, but the cool thing is you can use a jump trade on pretty much any stock you like. So pretty much any trade you like, you can apply a jump trade to. If you think it's going to go up a lot or down a lot, you can use a jump trade. Step 2 is to analyze the expected move. So we do this by calculating what the market makers are projecting for a specific stock over a specific time period. Now, when we move into the charts, I'll show you how to do this quick and easy. But importantly, You need to know what the market makers are expecting. By the way, folks, even if you don't use jump trades, I still think that you should do this on any trade you take. You should know what the market makers are expecting and make sure that you're not trading for a much bigger move than they're expecting, because if you are, you're stacking the odds against yourself. Step 3, choose a target less than the expected move. Now, I usually try to go for less than half the expected move when possible, because I want to make sure that the move that I'm asking the market to make is extremely reasonable. I'm not asking the market to do double what it's expected. Often, I want to go for about half the expected move and still be able to hit a triple digit gain. So think about it. I want to go for half of what the market makers are expecting, get 100% gain, whereas a call option needs to go over what the expected move just to break even. Okay, that's the difference between jump trades and a regular move. Okay, step 4, choose your time frame. In other words, your expiration date. Every option has an expiration date. You have to choose that expiration date, which means you have to choose the time frame that you're expecting the market to make the move in. So what I simply do here, really easy, nothing crazy. I just look at how long the average move takes. Okay, so I look at Apple and I say, listen, I want Apple to go up $6. Well, on average, does Apple move $6? No, it only moves $2 in a week. All right, well, I need to go out 5 weeks. I need to go out 8 weeks. So all I'm doing is saying, listen, if this does work out in my favor, if it does move up, how long does it typically take to make that kind of a move? And then I give it some extra time, some extra cushion to make that kind of a move. Not rocket science. I'm just looking at how fast does a stock move. You can use an ATR. You can use lots of different things to do that. Again, the market maker move itself is going to give you kind of a time horizon. And you just say, okay, let me give it some extra cushion to make that move. Step 5, you're going to place your debit spread. Okay, call vertical, call debit spread, whatever you want to call it. That's going to be the actual trade implementation here. What I do is I sell the call at our target level from step 3. Remember step 3? Choose the target. Okay, now I'm using that to say my target level is where my sell call is going to be, and then I'm going to buy the call 1 strike lower. And that in and of itself is going to create a debit spread. We'll go a little bit deeper in detail here in a minute. Step 6 is going to be to place a target. So this is those good till canceled limits that I love to use. And as soon as our trade is filled, oh, wait, speaking of filled, did you guys hear that ding? I just got filled. Oh, nice. All right. Love it. I just got literally, as I said, GTC limit, I just got filled on one of my GTC limits. And another one. What is going on? Boom. Automated option just filled. Guys, the timing of this is beautiful. My GTC limit for my automated option QQQ trade for, $1,000 or whatever it was, just got filled as I literally am talking about GTC limits right now. So great timing on that. But these limits sit in your brokerage account and wait to get hit at any time. For example, I might be live on Opening Playbook, not looking at the charts, and hear a ding because that GTC limit is working in the background to get me paid as long as we get a move. And that's exactly what just happened. I just got filled on automated options for a beautiful win without even paying attention to the charts. And that's why step 6 is so important. All right. Let's take a look at a real trade. And then we'll go into, a live trade on the charts itself. So step 1, trigger. This is HII. Breakout trigger above 270 equals trade. Step 2, look at the expected move. Expected move here for HII was to go to 286.50. Step 3, we're going to pick our target. So the expected move up here, 286, we're going to pick our target, which is about half the expected move of 280. Okay, so expected move 286, we're setting our target at 280. Step 4, we're going to choose how much time we're going to give it. Basically, that means we're choosing our expiration date. Okay, and we'll go through the expected move here in a second. We gave it 4 weeks. Step 5 is we create a debit spread where we're selling the option and buying the option. Remember, we know what we're targeting because of step 3. We know what we're targeting. In this case, the debit spread was buying the 270 call, selling the 280 call. Okay, why are we selling the 280 call? Tell me in the chat. Why is it this debit spread? Why are we selling the 280 call in this trade example? Because this was our target, 280. That's where we want to get it above, right? So that is where we're going. Yep, Mike, Christine, Dave, you're on it, because that's the level that we're targeting. So that tells us we don't have to go guess what spread we're going to trade. That tells us what spread we're going to trade right there. And then step 6, we set a target. In this case, the limit was about $9. And so depending on what you paid, 100%, 200% target on the actual limit. Okay, so quick recap here of what we're doing in jump trades. We're playing strong momentum stocks where we do need to move in our favor. This is not an income trade. This is not an income machine trade like I gave you earlier. This is a directional move in our favor. Unlike regular call options, we don't lose in most scenarios, even when we're right. So we still do lose if the trade doesn't go against us. But if it does go in our favor, we don't still have all these losing scenarios we have to overcome. Instead, we have winning scenarios. By using a directional debit spread, we can target a specific area, always sell the call at the target level, and buy the call one strike lower for a huge profit. Now, when I say huge profit, I don't mean we hit a huge profit every time. What I'm saying is with a jump trade, if you're not getting a huge profit potential, you shouldn't even take the trade. You shouldn't ask for a big directional move without getting a big payoff. This is why so many people lose on call options. They require the market to make a big directional move, which is a lot to ask, and they don't get a big ROI. Don't do that. Only take the trade if you're going to get a big ROI. Not only do we have way better profit potential, but they're much, much cheaper to trade as well. Which if you want to trade stocks like NVIDIA or MSTR, Meta, you need a lot of capital to do that. Did anyone happen to look, by the way, all my jump trade members, did any of you guys happen to look at what those Meta calls were going that we trade, like the 245 calls, the regular calls? Because they were like $4,000 or something, or maybe $5,000 for one call. One option was like $5,000 yesterday. And we traded it for what? $100, $115. So $5,000 for a call option, 115 for the debit spread. Much, big difference. We set the target as soon as the trade is filled, so the broker automatically exits the trade for us if price hits our limit order. Okay, so we're going to move on to our live trade now, but at first I want to make sure that my beginners in the room are not left behind. So let me ask this question. Can I do a poll here? Is it possible to do a poll? Deanna said I could before, but for some reason I don't have the option to do it. I was going to ask and see if enough people needed a briefing on basic debit spreads before we move on, because I don't want to leave my beginners behind if there's enough of you in here. I can't do a poll though. I don't know. I got to figure out how to do a poll in these rooms. Okay, looks like we got a lot of newbies in here. Okay, so I'll run through this pretty quick then, and I'll give you guys a separate briefing on this later. I'll give you a quick briefing on how debit spreads work, and then we'll jump into live trade and do that as well. We're going to trade Apple today. Okay, so a debit spread is any trade where you buy a more expensive option than you sell on the same asset and the same expiration date. All right, so buy a call, sell a call at the same time. Debit spreads are like buying any other option, except you're selling one at the same time to reduce the cost and counteract the time decay. All right. In jump trades, we do this by selling the call at a target level, like I just shared, and buying a call one strike below the target. For example, if we're targeting $480 on the QQQ, the actual trade here is sell the 480 call, buy the 479 call. Notice that if our target is 480, that's the one we're selling, we're buying the one directly below. The cost of a debit spread is the difference between the two options. Okay, so if you're wondering how much do debit spreads cost, well, you are buying one, you're selling the other, and the difference is what you pay. So if you buy an option that costs $800 and you sell an option that costs $600 at the same time, the spread is going to cost you $200 because that's the difference between the two prices. Your broker should always let you buy and sell in one trade at the same time. So these are not two separate trades. You do them in one ticket, they call it. Most brokers call that a vertical or a call debit spread. Okay, so you're doing that in one trade. So let's look at Apple options. Okay, this is from like a year ago, but it's the same example. So obviously, every Apple option has a price, right? You could buy and sell any option. Here I'm looking at the buy side of the calls. Here's an option that cost 113. So 113 here is what the option costs to buy. That's a regular call. If we wanted to do as a debit spread, we have to sell one that costs less. Okay, so you flip over, you look at the sell side of the call options. Here's one that costs 65 that we can sell. Okay, so if you get 65 from this trade, what you're doing is you're selling an option that's less than the one you're buying. And the net difference is what a debit spread actually is. Okay, that's what a debit spread is. You buy a call, you sell one that you get some value back from, and the net difference is your debit cost. In this case, you sold one for 65, you bought one for 113. Your net debit cost here is $48. Pedro, I don't know what broker you're using. Every broker on earth these days should let you do a debit spread in one ticket. And like Robinhood has the builder, TOS has the vertical builder, E-Trade, Tastyworks. I mean, every single broker that I know of has the same ticket option. And if your broker doesn't, I would recommend a different broker, not to be too harsh, but that's crazy. Okay. Now the big question is, what's the risk, right? Or at least that should be your question. What is the risk when you're buying a debit spread? Well, the difference between strike prices represents the opportunity in the debit spread. That's how you're going to find your risk to reward. Okay. So a $10 difference, meaning you sell the 250 put, you buy the 240 put, for example, is $1,000 an opportunity. I'm using puts here, but this would be puts or calls. $5 difference is $500 an opportunity. 250 difference is $250 an opportunity. So whatever that difference in strike prices represents your opportunity. So to understand risk, basically you just need to understand the total opportunity versus what you are paying for the trade. So let's walk through it. Okay, so if you're buying a 205 call and you're selling a 210 call and you're paying 150, what is the risk of the trade? Anyone know it? So you're buying the 205, you're selling the 210. This is a debit spread, so you're paying up front 150. A couple of you got it. Yes. So your risk here is 150. Okay? With a debit spread, it's like a call option. Your risk is whatever you're paying. So in this case, you're risking 150. Whatever you paid, that's the risk you have on the trade. Now, we know we're paying 150. The harder question is, what's the potential reward? How much upside? What can we actually make on this trade? Which, by the way, I've heard a million people teach on spreads and they never answer this question, which I think is wild. But yeah, you guys are smart. You got it. Okay, so the potential reward here is, we know it's a $5 spread, which means 500 of potential. We know we paid 150, so the potential is 350 left over, 350 bucks. So we know before even opening the trade that our potential is 133% because we know exactly what we're paying and we know exactly what our potential profit is. On a debit spread, you know that going in. That's what I love about jump trades. You always know, what's my risk to reward? It's defined in advance. Where's my line in the sand? How far do I need the trade to go? What's the time horizon? How long do I have to make that move? You know all of that information in advance as soon as you set up the trade, which I absolutely love about jump trades in advance. You can set this trade up knowing all of your parameters, not guessing anything else as you go. All right, a ton of you got this, by the way. I don't know if I can take credit for you guys understanding this or if you just are smart, but I remember the first few times I went through this, most of the people in the chat seem to have never heard about how to set up the risk to reward or how to know how much profit potential is left. So it's awesome to see how many of you guys are on the ball and getting this. By the way, I am doing a full jump trades presentation here on jump trades at 1 p.m. today. So I'm going to do a full presentation, go deeper, more examples. I'm going to do another like 100 spots in jump trades membership before our next trade because we're going to do another bonus earnings trade and probably an official trade after that as well. So probably get 2 jump trades this week. So if you guys want to join me at 1 p.m., I'll post a link. Actually, I think I have a link here. Let me grab that now real quick. I know a lot of you guys are already members, so you don't have to worry about you don't have to worry about joining the 1 p.m. But if you're not a member of Jump Trades, here's a link if you want to join me at 1 p.m. Would love to have you guys there. I'm going to go through it even more detail, lots of examples. I'll also at the 1 p.m. I'm going to share a little bit of the dirty sauce behind what's happening. When I say options are rigged, I'm not joking. I really mean it. And at 1 p.m., I'll go through that a little bit more in detail as well. So that's for 1 p.m. In the meantime, who's ready for a live Apple earnings trade? You guys ready? Let's jump in. And yes, Gloria, we record every single 10 a.m. session. You can go back and watch every single one of them at your leisure. But of course, a lot of times we do live trading. So if you want to get the good stuff, a lot of times you have to be there live for that because if we do a live trade, sometimes the pricing is gone, all that good stuff. Jackie, the recordings are instant actually. So the recordings show up instantly in YouTube. You don't even have to wait for them to render, which is kind of cool. All right. By the way, look at this market. Mag's up 4.2%. Bitcoin up another. Oh, dude, IBIT is a monster. I took a couple contracts of this one that Graham gave out, by the way, here. This was the 54, 50, 55 that Graham gave out. I took a couple of little contracts. I like to take even the trades that I already have. So like IBIT, I already have tens of thousands of dollars in. So I'm not usually going to take a ton of directional trades, but I like to throw a few contracts on just so I can track it with you guys. And I know what's going on. You know what I mean? Like I don't want to, when someone asks me, hey, what did we win that Apple trade? I want to at least have some idea. So I try to take at least a few contracts of almost all the trades that we put out. Okay. So let's look at, this is Thinkorswim rec that I'm on. So you'll see me use this for all of the live trades because it's where all my live money accounts are on at this point. But obviously you can do debit spreads on any broker. All right. So the first thing we're going to do here is we're going to go over to Apple. Okay. Now, you can see right here, the expected move on Apple is actually pretty small. It's only about 4% right now versus the Meta one was like 8%-ish. So Apple has a much smaller expected move right now than Meta and some of the other ones. What's the other one? Who else is today? Why is my brain going blank? Who else is today? I just showed you on the on the thing, the other Mag 7 today. Oh, Amazon. Thank you. Jeez. Okay. Amazon, little higher, but about 5.5%. Thank you, Mark. So not as big of expected moves as Meta. So what this means, this tells us something right off the bat here. This market maker move, $9, tells us something really important. It tells us that if we trade Apple up at 221, because it's 212 right now, so if we trade Apple up at 221, we are requiring two things at the same time. We are requiring Apple to make its full expected move or more and get the direction right. Now, I personally think this is why most people lose money on earnings. Even though they're a coin flip trade, and they should be about 50-50, they're normally requiring it to do both things at the same time, and that's a lot to ask. It's a lot to ask the market to make its expected move and get the direction right at the same time, which is what most people are doing on earnings. Okay? So what I do with jump trades is I go way inside that expected move. How do we do that? By the way, if it wasn't an earnings trade, because jump trades is not an earnings strategy. The earnings trades are just bonuses. Jump trades is a regular directional strategy that I use all the time for different stocks. So for example, let's imagine that you're trading a stock that doesn't have earnings and you still want to look at the expected move. Well, this market maker move is just going to be for like the day. But what you can do is you can go down here and look at the expirations. Okay. So I think it was Rick, who just asked, or no, who was it? Oh, Russ just asked. How do you know the expected move? Well, you can go to these expirations, and right here it's going to tell you $12 over the next 18 days, 8 days, $15 over the next 15 days. You can go all the way down, $40 plus or minus over the next 169 days. So, Russ, it's going to tell you the expected move in your options chain over every time horizon so that you can match up that with how you're actually trading it. Okay? In this case, of course, we're just trading tomorrow's expiration. We're trading a 1-day trade here on Apple where we're looking for it to go up less than the expected move. So remember, step one, entry. Well, we already know our entry is going to be a bullish entry on an earnings move. Okay? Then we're going to look at the expected move, which in this case is about $9. Then we're going to see how much time we're going to give it. We already know we're going to give it 1 day. We're not trying to trade Apple for the next month. We're trading 1 day binary earnings trade. So we already kind of know our first couple steps. Then we need to choose our target. What's our target going to be here? Well, like I said, I want to go inside this expected move. So this right here is going to tell me, listen, I need to go for, like a $3 or a $4 move, not a $9 move. If the expected move was $40, I could go for a $9 move. But $9 is the expected move, so I want to go for a $3 or $4 move. So what I'm going to do is I'm going to go to vertical. This is already set up right here. You can see vertical. That's meaning a debit spread or credit spread, but in this case, we're going to do a debit spread. And I'm going to set up an Apple trade that requires us to move much less than that expected move. All right, so Apple's trading at 212 right now. I can buy the 212.50, 215 here for about $1.25. All right, so that means about exactly 100% gain potential. How do I know? Well, because the spread's 250. We're going to pay 125. That means we also have 125 left of profit potential, meaning 100% profit potential. Okay, now what I want to do here is really important. I want to actually look at how much extra ROI I can get by going for a larger move. Okay, how do I do that? Simply look at the prices. So if I require it to move to 217.50 instead, which is about a $5 move, you can see that I can get in for about $1.04, $1.05. Well, that changes the risk reward quite a bit. Again, 250 spread. If you pay $1.05, now we have $1.45 of profit potential. So we just change, if we go up $2.50, instead of being able to get about 100%, now we can get about 140% ROI by moving that up. So then the question that we have to ask ourselves here is it worth the extra ROI to require that bigger move? Does that trade-off make sense? For me, the answer is usually no on an earnings play. The reason being that $2.50 moves me much higher up on that expected move for about a 40% return in ROI, yet my downside is losing 100% if I'm wrong. And for me, that risk reward doesn't typically pan out. Now in Meta, the expected move was like $35, and going up in strikes were getting me like, a 10% extra ROI. Made no sense at all. So I just kept a very conservative ROI and went for 100%. In most cases, moving up that ladder and going for more profit is not a great payoff, in my opinion. So for me, I would just stick to the 215 here. I would just say, give me a comfortable move inside the potential move. And as long as it hits that, I'll get 100% ROI. I'll be happy with it. And even if it goes up to 230 and makes a massive move, then I'm fine. I'm going to hit my target. Okay, so the way that you would do that is that you would set this debit spread with a buy to open the May to Apple 212.50 call. You would sell to open the May to Apple 215 call. And we'd pay about 125. It's bumping around a little bit, but you should be able to get in for about 125. Now, the exit on this one is a little bit different because I actually probably would not set a good till canceled order on this one. The main reason being because it's a 1 day trade. So in this case, I would usually just let it expire and go for the 100%. Now you could set a target. You could set a target for $2 and just go for like an 80% win. But for me, I would on a 1 day trade, I would usually let it expire. Okay, does that make sense? So again, I'll pop it in the chat there one more time. You buy it open the 212.50, you sell the 215. That's our target line in the sand. And now we know if you go to the chart, okay, so if you go to the chart here, go to Apple. Now we know. Here, let me go to the daily chart just so you can see it a little bit better. Here we go. Now we know that anything above this line right here, let me go a little higher, right here, 215 is a win. Anything below 212 is going to be a loser. Okay? Sheeta, if you let it expire above 215, you will gain $2.50. So if you pay $1.25, it expires above 215, you're going to get exercise for a full $2.50 value, and that's 100% ROI. All right, so May 2nd is the expiration, $1.25. Let me just do one real quick here to see if I can get filled at the price, just as an example. What I'll probably do, folks, is I'll probably add a little bit more at the end of the day on this because I usually trade these earnings at the end of the day just to take any extra noise between now and earnings out. But I want to see if we can get filled here. Lure got filled for 125. I didn't get filled yet. Just sitting in there. Price did bump a couple pennies, but we'll see. Now, what you could do, folks, let's say that you want to trade Apple with a high probability that if it goes up, you're going to win. Well, that would be this trade. If Apple goes up, you're probably going to win because it's probably going to go up more than, $2.20, right? So that's, there it goes, filled for 125. So this is the high probability version if Apple goes up. Does anyone in here think that Apple's going to crush and that Apple could beat this expected move and go up $12? Anyone super optimistic on Apple? Because what you could do is you could take this 220 trade or even this 222.50 trade. This would be what we would call like a super beat trade. And this one you could take for about 60 cents. And so what you could do is you could have 10 contracts for the safer trade. It's not safe, it's still an earnings trade, but it's the safer trade. You could have 10 contracts for that. And then you could throw 3 contracts in to the super beat trade. And it's kind of a hedge, like a backwards hedge, if you will, against if winning, if it does have a huge beat, where you could trade. And your ROI here, if you look at it, would be 60 to 180. So this would be like a 300% winner if it hits. Okay, so you could send this trade off. Boom, 62 cents. Now, if I hit that trade, if we hit a super beat on Apple, that trade will return 300%. And so you can kind of ladder these jump trades if you want. So if you want to take like a super aggressive version of this trade, you could do this one. Same expiration, same structure, just with higher strikes. Okay, so you could do the 220 call, 222.50 call. And this one, you could pay about 61, 62 cents. I got in for 62 just now. All right. Hank, no. Okay, so sounds like not everyone is on the same page with what it means when it expires above both strikes. Let me cover that real quick here. Okay, so what happens? I'll get rid of this actually. What happens if we trade this and it expires? Let's just go through the scenario so that everyone understands. All right. So we sold the 215. We bought the 212.50. Okay. If Apple, which is right here, right now, in between, well, actually, it's actually at the lower end. My chart's not right. But anyway, if Apple pops above this level and then expires tomorrow. So this is the end of the day tomorrow. Above this line, anywhere above this line. So anywhere between here and higher at the end of the day tomorrow, what happens? Well, what happens is you have the right, in technical terms, you have the right to buy shares at 212.50 exercised, and you have the right to sell shares at 215 exercised. All right? That's what's happening in technical terms. So what does that mean? Well, think about it. If you exercise the right to buy shares at 212.50 and at the same time sell shares at 215, what does that mean? Think about it. What does that mean? If I have the right to buy shares at 212.50 and sell at 215, I just made $2.50 on every contract because I can buy at 212.50 and sell at 215, 250 higher at the same time. Okay? So that's what exercise means. It means you're going to get the full $2.50 value of that spread. Everyone got it? That's why we're going to let it expire. Because if it expires, that's how we get the full value of our spread. You just let it expire anywhere above this line. If it expires below this line, it's the opposite. You lose. Whatever you paid $1.25, you lose $1.25. All right? And okay, so some questions about the spreads. You can do the spreads. Yes, it's done automatically. If it expires above, it's done automatically. You do nothing if it's closing above the higher strike. It happens automatically. You get the full 250. Now, if price is in between those strikes, then you want to exit manually. Okay, so again, here's our strikes. Price pops down, pops up, whatever it does, and it's in between. Then you want to close it at the end of the day. Okay? Close it at the end of the day if it's in between those strikes. Exactly, Ralph. You paid the 125 debit, you get the 250 credit, you're 125 ahead. Bingo, bango. All right. So a couple questions here. Could you do wider spreads? Of course. Yeah, you could take, 210 and 215 and create a $10 spread, and you'll have a better risk reward. Right? Sorry, not a better risk reward. Excuse me. It's not. Nate, talk with real words. Not a better risk reward. You'll have more revenue per contract. You have less commissions if you do the wider spread. Bill, your broker may require the assignment, but you have the other side where you're selling the shares. So either way, you're good. Dexter, if it expires above 4 p.m. tomorrow above, then you are going to automatically get those exercise. You don't have to do any steps. You get the money. All right, everyone following? So you could ladder this a whole bunch of different ways. I mean, you could do a 210 and 220 spread. Once you get comfortable with jump trades, you can set these up a million different ways. Okay, so now you can require to make a $7 move. It's still a little bit less than the expected move, and you can get a little extra. But I like our trade. Now, the other cool thing that you can do, one cool thing that you can do here once you learn jump trades, which is not really a jump trade because you're not asking it to go in your favor, but on earnings, you could actually come down here close to the bottom of the expected move. Okay, so you could go to like 202, 250, which is a downside move. Notice 205 is about $8 away. So you're basically inside the entire expected move. In other words, if the market goes down $7.50, you would still win this trade. And you can get about a 25% ROI on on the downside protection jump. Whereas usually this trade would give you almost no ROI. It would give you like a 1% gain. But because it's earnings and you have this expected move, you can go down and play a 202.50, 205. And even if Apple comes down $8, actually $8.60, you can make 25%. That's another, again, I'm throwing a lot at you because once you understand the mechanisms here, you can do a lot of cool stuff. Ron, no, you. I don't want to speak for every single broker in the world, but most brokers, they exercise. They don't require you to have liquidity because you have the rights on both sides. They will tell you, hey, you've exercised, X amount of shares, but it's automatically covered. Like Robinhood, I think I had a $4,000 account where I had about $1 million worth of Tesla shares exercised, which wasn't exactly my plan, but it was fine because it was on the right side of a spread. And they said, hey, you have no margin for this, but it didn't matter because it was a 1-day close. So I don't want to speak for every broker in every situation, but I've done it 100 times, even in little trading accounts, and always had fine, a fine experience as long as it was a spread and I had both sides. Linda, if you expire between the strikes and you don't close the trade, then only half your trade gets exercised, which is what we want to avoid, because then only the buy side gets avoided. Alan asked a good question. Do I prefer jump trades on earnings or two-way? It really depends on the expected move. Like for Reddit, so if you look at Reddit, here we have about a 13% expected move. This is one that I wouldn't mind doing a two-way trade on because Reddit's also a beaten down chart. It could have a really good response to the paid side, or it could have, a very positive. Like if you look at the chart on Reddit, here's Reddit. Look at the weekly chart. It's down 50% from the highs, and it has this new model, so it could easily bounce to 150, but it could also bounce down to $70, right? And so this is one that I would like a two-way trade on. Now, on a two-way trade, you have to trade a little further out, but you still trade inside the expected move. Trade the 133, 134, see if you get filled for 30, 40 cents, then come down and trade, in the 102, 103 range. Each side has a 300% potential. One side's going to lose. Christine, there will be one. There will be a profit pair trade today. We usually do profit pairs on Tuesdays, but because the sectors were shifting from April to May, I just waited for May 1 to get an official sector update, and that trade will come out today. Joseph, this one I am not putting a limit on. Now, almost every trade I do, especially jump trades, will have a limit. But when it's a 1-day trade, the limit, to me, caps the potential. Again, usually I always use a limit because if the market makes a move, I want to get out. But when it's a 1-day trade, it changes the dynamics because if you put a limit on, then you're kind of capping what your all-time potential is there. And with 1 day of time, it's kind of boxed in for how far it can move. Now, you can put a limit. Don't get me wrong. If you guys feel more comfortable with the limit, set a limit, set a GTC, set it for $2, and you can still make whatever that is, 80% on the trade. So no problem setting a limit. But when it's a 1-day trade, I usually just try to let it expire and get the full 100% gain. All right. All right, folks. Well, again, hopefully this was helpful. Hopefully the jump trades class is something that, not only is cool for, finding some earnings trades, but more of a fundamental understanding of how the market works and all that kind of stuff. Nice, Hank. What was your trade on that one? And at 1 p.m., I'm going to go a little bit deeper on that. I do have an official jump trade service where, I give trades every week or most every week. I mean, the conditions have been a little bit crazy lately, but most every week I give an official jump trade, not an earnings trade, but my own directional trade. And if you guys want to learn more about jump trades, join me at 1 p.m. I'll go through all the details. on that, how it works, and we have a little special discount to get you in before our next bonus earnings trade on jump trades. Oh, Hank, so it was a jump trade. Hank made 281% on a Microsoft jump trade. Love to see it, Hank. That's awesome. All right, folks. Well, thanks again. Hope to see everyone around 1 o'clock today for the kind of official jump trades presentation. Um, and if you guys need the replay, it's just directly on YouTube. Deanna, if you're still on, would you mind posting that YouTube link? A couple people asked about how to grab the replay.
Yeah, give me a quick minute.
All right, thanks, Dave. Thanks, Dexter. Hank, Carlos, appreciate you guys. Jr. Dorley, no, I'll do more than 1 day, but if I'm doing more than 1 day, I'll usually use a target. So if I'm doing like a couple day trade, I'll usually use a target. Because really the only trades you can do 1 day earnings on are if the earnings happen to be on Thursdays, which Apple happens to be on a Thursday. But if the earnings are on a Tuesday, Wednesday, you can't really do a 1 day trade. So then I'll use a target. See you, Russ. Bye, Aaron, Ron, Dale. Man, it's the Rons. I got to tell you, the Rons are coming on strong today. All right, Pete. Thank you. Alan, see you. Bye, Andy. See you guys at 1 o'clock. Thanks, Joseph. Bye, Ernie. Thank you. Have a great day. If I got to talk to you guys at 1 o'clock, I'll see you tomorrow on Opening Playbook. Thanks, RJ. Talk to you later. Yep, Chris, we'll see you later. Ron H, another Ron. Love it. See you later, Ron, Lydia. Bye, everyone. Bye, Pete. All right. See you later, Carl. Well, thank you, Lauren. That means a lot to me. I always hope and pray that when I do these sessions, that it's not me just talking to the wind, that it actually makes sense and clicks and is valuable for people. So it's great to hear. Thank you. Thank you, Lauren. Bye, Gene. See you, Don. See y'all at 1 o'clock. All right. Bye, Sean. Bye, Carl. Oh, yeah, Carl. The weekend trades are hopefully going to be more common now because we're getting some stabilization now. VB, thank you. Christine, thank you. Ron, do you mean directly from the Zoom? Like from inside the Zoom? Bye, Rick. Thank you. See you guys later. Yeah, Mike, I'm going to share the slides. I think I have to download them and share them in Telegram. I think it's the only way I can really get them to share correctly. Huh. I would think that you could just highlight it and control it. I'm not sure on. All right, Susan, see you at 1 o'clock. Thank you, everyone. Oh, Deanna said they don't all allow you to easily copy it. Interesting. That is strange. Huh. Might have to YouTube that one. Thanks, Mark. Ron, you might have to YouTube how to copy and paste with your computer because I have no idea why it wouldn't let you highlight it. That's just bizarre. I mean, I wish I was smarter for these kind of problems, but I'm clueless. I have no idea why I would not let you copy and paste because I use it all the time. Copy and paste things out of the chat. Okay, folks.